Hey, Bill Leatherman here for Money Evolution. In today's video, we're going to be going through and helping you to create your retirement tax plan. So if you've been working on this for a while, you're really getting into some of the retirement planning, understanding different elements of that. One of the things that you're probably starting to figure out is that taxes are a really big deal, especially as we're talking about how to best optimize all of your different retirement financial planning resources that you have. And unfortunately, unlike some of the other expenses that you may have, taxes are one of those things that never really go away. They're going to be with us really for the rest of our lifetime. And especially if you're somebody that might have a lot of money in traditional retirement accounts, one of the things you may be thinking about is that balance in those accounts and the growth of that account over time, is that going to be a problem later on in your retirement plan, especially when those required minimum distributions kick in at either age 73 or age 75, depending on what year you were born? And for a lot of people, the answer to that is yes. So we're going to be getting into a lot of details here and really helping to answer a few questions. Number one, we're going to help you determine, is that required minimum distribution later on going to be an issue for you? We're going to talk about how we're going to determine that. We're also going to be talking about some of the other big questions or decisions that you might be thinking about. One of those, if you're still working, is going to be, should I be saving money into a Roth account or should I be doing a traditional account? So we'll be talking about that decision, very big decision on really getting that best optimization for that savings that you're doing there and making sure that's not going to save you money today but mean more taxes later on. We're also going to be talking about things that I refer to as the low tax years. Really a good majority of the plans that we do have those low tax years. That's going to be the early part of retirement where there may be some opportunity to do some asset shifting or do some of those Roth conversions that we're talking about there. So we'll talk about that a little bit. And then Roth conversions, probably that's something that's on almost everybody's mind these days. And we just had the passing of the One Big Beautiful Bill Act. So the Tax Cuts and Jobs Act that were set to expire at the end of this year, now these tax rates are now made permanent. So does that mean you should not do Roth conversions anymore? Does it not make sense anymore because our tax rates are going to be more consistent over time? So we'll be talking about that as well. And so what I'm going to be doing in the first part of this video is sort of really laying out the framework and some of the methodology, and we're going to be talking about the different phases that you're likely going to be going through these different tax phases of your retirement plan, and then what you should be thinking about during each one of those phases. So we're going to walk through that framework, and then later in the video, we're going to be hopping over into our eMoney advanced financial planning software and really laying that out with the Tim and Jill Mitchell case study that we've been working on in some other videos. And we'll be talking about how to really implement some of these different strategies and how it could potentially help them save some money. So in taxes, that is. So anyway, we're going to dive into all of that. But real quick, before I do, if you'd like to learn more about the financial planning that we do, you can head over to our website, moneyevolution.com. And you can also check out our Retirement Time Machine program, which is going to be a great tool for most of you to put together your retirement plan and really map some of this stuff out. And you can learn more about that at retirementtimemachine.com. And it's a great program. We've had a lot of clients go through that already and really gotten a lot of benefit out of that. So we'll dive right in here. Okay, so let's dive in. So when it comes to tax planning, there's really one question that's above all others in terms of understanding and optimizing our taxes. And it's, what is our tax rate today versus what is our tax rate going to be in the future? And how is that tax rate going to change over time? So I'm going to get into here in just a little bit what I call the 4 different phases of our tax roadmap. Starts off with, what is our tax rate while we're working? What is it maybe in the early part of our retirement, especially if we retire before Social Security and maybe a pension kicks in, and then what is it during normal retirement, and then what is it later on when those required minimum distributions kick in. And so understanding what those tax rates are going to be over those 4 phases is going to be the key to really optimizing our taxes and really implementing some of these strategies. So as I mentioned at the beginning of the video here, we did get some new tax legislation passed here in 2025, and essentially what it did is it made permanent the Tax Cuts and Jobs Act rates, which went into effect in 2018, but had a sunset provision. Those rates were set to expire at the end of this year in 2025. And if they had expired, we would have reverted back to the old tax tables we had back in 2017, probably with some adjustments for inflation. But what that would have meant would have been higher tax rates across all income spectrums. So it was very easy to say that our tax rate today is likely going to be less than what it's going to be in the future if we would have had those other tax rates coming back in. So now that we've got some clarity here, at least for the time being, we know what our tax rates are going to be out into the near future. Now, when we say permanent as it refers to tax law, that only means until some new Congress and a new president enacts some new tax legislation. And we do have a lot of debt, and some people are concerned, including myself, that we may see higher taxes down the road. So what we're going to be doing in this example is just assuming, because we don't know anything else at this point, we're going to be assuming that these tax rates are going to be with us here for the foreseeable future. And that's how we're going to run through some of this analysis here. So as we go through and we start working on some of these tax optimization strategies, most of these are going to revolve around how you invest, how you contribute, and how you withdraw money from these three primary tax buckets. And you probably already have money maybe in all three of these buckets. We have what we call our non-retirement account bucket, or sometimes we refer to it as taxable investments. That's going to be basically any bank accounts, money markets, CDs, treasury bills, things like that, or investment accounts, mutual funds, and things that you hold outside of any type of retirement account, like a 401k plan or an IRA or Roth IRA or anything like that. You also may have traditional retirement accounts. That's the original retirement account, those original IRA accounts and the original 401k plan was all money that went in generally on a pre-tax basis. It grew tax deferred, and then you generally pay taxes on that money when it's withdrawn. And then finally, we had more recently, the Roth accounts came in as the last type of retirement account, and that's money that was contributed on an after-tax basis, but grows tax-free and is withdrawn tax-free as long as it's a qualified distribution in retirement. So a little bit of trade-off. So each one of these are going to have their own special characteristics here. So when we're talking about non-retirement accounts, it's important to know there's a couple different types of income that you can earn there. One is going to be what's classified as ordinary income, and that's going to be interest that you might get from a bond or a CD, and that's going to be taxed at ordinary income rates, which is your highest marginal tax bracket. So that's going to be stacked on top of whatever other W-2 income, or if you're taking distributions from a traditional retirement account, it's going to be taxed at that highest rate. And also, if you have any short-term capital gains, that's also going to be taxed at that ordinary income tax bracket. And then finally, you might have what's called tax preference income, and that's going to be qualified dividends, generally from corporations' stock dividends that are paid out. And then you also could have long-term capital gains, and that's going to be taxed depending on what bracket you fall into, either a 0% tax bracket. Yes, it is possible. In fact, I just worked through this exact example with a client a couple of days ago in the office. They had a highly appreciated stock. They were in the early part of retirement, and we were able to basically capture a very large gain and pay zero taxes on it because they essentially had no other income coming in. So you can go up to, I think it's like $96,100 of taxable income and pay a 0% long-term capital gain tax rate on that. Qualified dividends also fall into that category. So it could be 0, it could be 15, or it could be 20. You also may get hit with something called a net investment income tax, and that's going to be if you're single, if you have investment income over $200,000, or if you're married filing joint, you have investment income over $250,000, you could get hit with an additional 3.8% tax on top of whatever that tax bracket is. So basically 0, 15, or 20. And then you could also have that net investment income tax. So generally, I'm not going to get into too much detail here in this video. If you have the opportunity, you want to focus on those things that are going to be at that tax preference rate. So again, one of those things that's going to be a tax strategy is what investments are you putting into each one of these buckets. So if you focus on those dividends or long-term capital gains, you're likely going to be at a little bit lower tax rate. rate in that situation there. Traditional, 100% of that is going to be taxed at that ordinary income tax rate. So that's going to be stacked up and that's going to be at your marginal tax bracket. And you can start taking those distributions at age 59 and a half as a qualified distribution, so you avoid that 10% penalty. Something I also talk about in other videos is if you separate service in the year in or after you turn 55, you can generally take an age 55 rule distribution penalty-free if you're coming out of a 401k plan or employer-sponsored retirement plan there. But generally that's going to be all taxable. And then finally, those traditional accounts are also going to get hit with required minimum distributions. And that's going to be, depending on what year you were born. If you were born in 1960 or later, that's going to be age 75. And if you were born before 1960, it's going to be age 73. And that's essentially where the IRS says, I like to refer to it as, you've gone long enough without paying any taxes on this money. Now, whether you want it or need it, you're going to have to start taking these mandatory distributions there. By the way, if you have inherited IRA accounts, you're going to have to start taking those required minimum distributions pretty much, depending on the age of the decedent, either immediately or you're going to have that account distributed either way within 10 years. So that's something that also kind of goes into that tax plan, and that's going to be one of those less flexible situations where you're going to have that income that you're going to have to account for there. And then Roth accounts, they don't have an RMD, so you can leave that money essentially in that Roth account for the rest of your lifetime and pass it on to your kids. Your kids will have to start taking money out, but you can leave that money in there as long as you want. And as long as it's a qualified distribution, it's going to be 100% tax-free. So generally, as we're looking at this, so again, non-retirement accounts, we want to focus on those preference rates. In the traditional accounts, we may want to have more of our conservative investments. So if we want to have a bond allocation, something that's going to be a little bit safer type of investment, we're going to put that generally in the traditional. And then in the Roth, generally that's going to be where our growthiest investments are going to be, because again, assuming that we get that growth, getting that tax-free is going to be the best option there. Putting the more conservative investments in those traditional accounts is going to effectively slow down the growth in that. And so if we're doing our asset allocation, we can have our same asset allocation, a 60-40 or a 70-30 or wherever you want to be, but you can put more of that growth in the Roth accounts and put more of the conservative investments in the traditional accounts. So to really map this out, we're going to really want to know three things. Number one is how much money is maybe going into each of these buckets on an annual basis. So are you contributing to a Roth or a traditional? Are you building up any assets in non-retirement accounts? Or maybe you inherited some money in those non-retirement accounts, whatever that may be. So number one is how much money is going into those buckets. Number two is what is the growth of those buckets. So again, you may have different growth rates on the Roth that may be growing faster than your traditional, whatever that may be, but you're going to want to have some kind of a way to map out what are those buckets going to be maybe at retirement, what are they going to be in the early stages of retirement, and what are those buckets, especially we want to know what is that traditional bucket going to be at the time your required minimum distributions are coming in. So how much is going in, how much are they growing, and then finally when you start taking withdrawals from your retirement accounts, how much money is coming out. So generally speaking, most of our plans are going to focus on taking money out of these non-retirement accounts first, and then taking money out of traditional, and then finally letting those Roth assets grow. So depending on how much you need to take out of those accounts every year, that's obviously going to be a determining factor of how much money is going to be in those accounts later on, and especially how much money we're going to have to take out for those required minimum distributions. So what it effectively looks like as we start to map all of this out is just like this. So we have these four phases that we're going to go through, and there's going to be a couple things that we're going to want to fill in initially here. So one is while we're working, we might have some W-2 or we might have some business income that's coming in. We may have some interest that we're earning from our money markets or CDs or things like that. We may even have some dividend income that's going to come into here. Again, one of the things I want to clarify on that, so the dividend income, if it's qualified, as well as those long-term capital gains, that kind of gets separated out. So that doesn't actually increase your marginal tax bracket. So that's calculated separately, but we still want to know what income is coming in here, and especially if we're maybe in one of those positions where we're going to be getting hit with that net investment income. tax, that is going to all go into that to determine if we're over those thresholds where that 3.8% tax would kick in here. So we're going to want to know that if we inherited an IRA account, or we have deferred comp, or we have a stock option or restricted stock that's coming up every year, we're going to want to have that mapped out so we know exactly what that income is and how that income is likely going to be changing maybe in those final years before you end up retiring. Maybe you get bonuses. Maybe you're going up the corporate ladder and those bonuses are starting to get a lot bigger. So understanding what those tax brackets are going to be in a few years is going to be very, very important. Early retirement, I define that generally as before FRA, which stands for full retirement age, and that's at, for most people, age 67, and that's when you're eligible to get unreduced Social Security benefits. So we basically start off almost all of our plans with a default of taking Social Security at that full retirement age. But if you want to retire at age 58 or age 60, you're likely going to have some years where your taxes are going to be very low during that time period. And if you have money that's in those non-retirement account assets, you're going to maybe be able to live off of that and really just maybe focus on those long-term capital gains or dividend income to basically support that. So you may be in a low tax bracket here, and that may be where we're going to have that opportunity in most situations here to do those Roth conversions. And we're going to talk about that when we get into the case study example here. So what does that look like during early retirement? Of course, if you have all of the money or most of your money in those traditional retirement accounts, some of the money in those traditional accounts are going to be needing, you're going to need to use that for your living expenses. So you're going to have to take withdrawals out. So if you need $100,000 out of your traditional retirement account to live off of, you're going to start that off with $100,000, and then the Roth conversions would be if it makes sense to do more income over and above that. And then here we're going to take Social Security, most likely. In some cases, it might make sense to turn Social Security on a little bit earlier there. And ultimately, that Social Security decision is also a very big tax decision as well, because for some people, it may make sense to delay taking that Social Security benefit for two reasons. One is it's going to increase your amount that you're getting from Social Security, but it also extends out those low tax years so you can do more of those Roth conversions potentially. And so that's some of the things that we work through there. I didn't put it on here, but a pension. Sometimes your pension may start right away at retirement, regardless of whether that's 58 or 60. Sometimes your pension may kick in at 65. So that could be something that you need to map out here in the middle if you have something like that. But then you're going to see, okay, what does my tax situation look like there? How much do I need to withdraw to cover my living expenses? And then how much room do we have in those tax brackets before we go into the next one if we're targeting doing something like the Roth conversion? And then finally, based on those withdrawals, based on what you're contributing to those retirement accounts between now and required minimum distribution age, and then what the growth of those assets are going to do, we can start to figure out what is that amount that you're going to have to take out of your retirement accounts, your traditional retirement accounts, to basically satisfy the IRS's required minimum distribution rule. And for some people, like I said, depending on how much money you have, that could be a very big number. So if you think about it, let's say you have $2 million in a traditional retirement account today, you're adding money to that. And if you're 55 years old, you could say that, hey, at a 7% rate of return, that money is likely going to double in 10 years at 65. So I might have $4 million. And depending on how much money you're taking out, if you weren't taking very much money out at all, if you had a bunch of non-retirement account assets, that could double again to $8 million. So your first year RMD is roughly going to be about 4%. So you could be looking at a $320,000 RMD. And depending on what the tax brackets are, and even if the tax rates stay exactly the same, that's likely going to put you up into a fairly high tax bracket here. So as we're putting together this retirement tax strategy, we really need to know about 7 key things. Number one, we need to know what's going into those different accounts. What are your contributions to each of those 3 different tax buckets? What are our growth rate assumptions for each of those buckets, and how much are those buckets going to be in 5 years, 10 years, 15, 20 years down the road? We're going to want to have something that accurately forecasts our expenses. What are the expenses we need for everyday living, and especially in retirement? retirement, that's going to go really into those retirement withdrawals and how much is going to be withdrawn from each one of those accounts there. We also want to understand that those expenses are likely going to be very variable there. So we may have, again, bigger gaps in the early part of a retirement, so that's going to be bigger withdrawals. We may retire before Medicare kicks in, and we may have higher healthcare expenses, or we may want to do more traveling in the early part of our retirement. So that's going to be bigger negatives coming out of our accounts there. We also want to account for inflation. So if it costs us $100,000 a year to live on today, in 10 years, it's likely going to cost us something a lot more than $100,000. We also want to make sure that as we're taking money out of these accounts, if we have to take a withdrawal from a traditional retirement account and we need $100,000 net to us to cover our living expenses, we're going to have to take out maybe $120,000 or $130,000 to cover all of those taxes there. So we want to have that accurately reflected there. And then we want to know and understand what's happening to our tax rates over time out into the future there. And it's going to be based on all of these different assumptions here. And one of the big pieces of that, we talk about inflation. So we have inflation for our expenses, but those tax rates are also going to have an inflation factor as well. So I used the example a couple of minutes ago where I think it was a $320,000 future RMD. Well, in 10, 15 years down the road, $320,000 of income may not put you up into obviously as high of a tax bracket as it is today, because those tax rates are adjusted typically on an annual basis for inflation. So the tax brackets are inflationary there. So we want to have something that can account for that. And then finally, we want to have a way, as we're talking about these different strategies, we want to have a way to easily model those different strategies and see what does it actually look like in 5 years or 10 years or 15, 20 years down the road if we do that Roth conversion? Or what does it look like if we do a Roth contribution instead of a traditional contribution? Is that helping or hurting our long-term tax situation? And what is it doing to our future growth of our portfolios there? So all of these things are going to be essential elements. And so we're going to dive into the financial planning software here, and we're going to be opening up the Tim and Jill Mitchell plan, and we're going to be kind of going through this and showing what exactly this looks like as we start to model some of these different strategies. Okay, so here we are, we're inside the eMoney financial planning software, and again, this is exactly the type of thing we do inside of the Retirement Time Machine program. You'll learn more about that at retirementtimemachine.com. But we have the Tim and Jill Mitchell financial plan pulled up here, and this is something I got into a lot more detail in another video, but we're here on the cash flow page, and one of the keys to this tax planning is really mapping out and understanding the long-term cash flow projections, because again, we have all of these different things that are going to be part of this, and one of those is going to be the withdrawals, and those withdrawals are going to be dependent on how much your expenses are every year, and also calculating the taxes every year. So if you did watch that video, we started off with Tim and Jill. They're 60 and 58 years old respectively, and they originally wanted to try to retire at the end of this year in 2025. That was a little bit of a stretch. It wasn't really giving us a very high likelihood of a good outcome there, so we made a couple of changes. We ended up bumping retirement out to age 62. We ended up modeling in a downsizing of their house, so they bought a little bit cheaper house, paid off their mortgage, and we also, though, because the plan started looking really good at that point, we added in some extra expenses and everything. So we can see all of that laid out here. So they're working basically just a couple more years here, and we can see they're retiring at the end of 2027. They have about $316,000 of combined income coming in. Over on the expenses, we can see some of that detail that we're talking about there. Everything from living expenses, if they did have a mortgage, it's being paid off because they're downsizing, and then their real estate expenses, and then the other expense flows, we can model in things like early healthcare expenses if they have to go out into the exchanges. They had a daughter's wedding they wanted to plan for, some financial support for one of their young adult kids. They had some traveling expenses, different levels of that. They wanted to travel heavier in the beginning part of retirement and then taper that off a little bit. We've got their car leases in here, and also calculated in here is going to be their taxes, and it's going to be dependent on everything that's happening. So if they're taking a withdrawal from one of those non-retirement accounts and it's triggering long-term capital gains, it's going to reflect that here, or if they're needing to take a withdrawal from a traditional retirement account. So that all looks really good. We can get an idea here of just some of the detail that's inside the software for taxation here. And we can see just by looking at the chart, while they're working, they have a pretty high level of tax. It makes sense. And then we have those early years where we have the low tax years. That's going to be one of our best opportunities for really getting some tax savings in here. And like I said, I think almost all the plans, or a very high percentage of the plans we do, have some of these low tax years. But we can also see too that later on, the amount of tax that they have is going to go up pretty substantially. In fact, actually, later in the plan, their taxes are about 50% higher than what they were while they were working there. So, and we certainly don't want to let some of those low tax years pass us by. And we also have state taxes here. So we're here in the state of Michigan. We're in the Metro Detroit area, but we modeled Michigan taxes in here. If you live in a state that has taxes, we very accurately inside the software can model that tax. So we can even see, right down to the bullet points, even if you're in a state like California or New York where there's high tax, or if you are in a state or planning on moving to a state, I should say, that has no taxes, we can model that here as well. So we can say you're in Michigan now, but in 5 years when you retire, you're going to be in Florida or Tennessee or Texas or some other no tax state. Then that's all going to go into the decision making. It's all going to go into that big question that we talked about earlier in the video. What is my tax rate today versus what is my tax rate going to be in the future? And we can see the effective tax rate over time, and then we can really kind of showcase just, I don't want to get too far into the weeds here, but what the detail is here, all the way from the above the line deductions, below the line deductions, your standard deduction, and we can see here too, that standard deduction, that's the inflationary piece that I talked about with the tax rates going, brackets going up a little bit. The deductions are also going to go up a little bit too, so we can see what that may look like. And then separating out the taxes that may be occurring from some of those preference items, which is not part of the income tax base or your marginal tax bracket, versus how much is actually hitting the income tax base. And there's a few years where it's zero, so again, we want to take advantage of that. And then over here, we can look at what that looks like as we map out those tax brackets over time. So we can see that very nicely here on this report here, and we can see they're in the 24% tax bracket right now today, and they are just in the bracket by about $50,000. They have $137,000 of room left in that bracket, and that's going to change a little bit year to year depending on all the different things that are going on there. And we can see where that goes over time. So there will be in the 10% bracket for the first few years of retirement. It jumps up to 12 and then 22, and then it, eventually later on goes up to 24%. Something I've talked about in other videos as well, something to think about. If you're married and you're filing a joint tax return and you have all your money or a lot of your money in those traditional retirement accounts, God forbid something happens to you or your spouse and you go from filing that joint tax return to a single tax return, basically those tax brackets are about half on most of the brackets of what they were at the married filing joint. But if you're talking about distributions to live off of, or your required minimum distributions, those are likely not going to change that much. So you're going to be hitting higher levels of taxation at lower amounts of income there. So it's called, sometimes people call that, I think, the widow's tax, I guess, there. And so you want to be thinking about that. So if that were to happen, and we can model stuff like that into here as well. So we wanted to look at just a couple of things, and this is something I call sometimes evidence-based recommendations. So as opposed to just like, hey, I think a Roth makes sense, or I think you should be doing this or doing that, we're going to actually put it into the software and actually show you what that outcome looks like here. So one of those is we said, hey, you know what? They're contributing money to a traditional retirement account. What if they put money into the Roth instead? What does that look like? And they only have a couple more years of working, but they're contributing a pretty good amount to their retirement savings, about $30,000 a year. That was one of the things we adjusted with our modeling when we were working on tweaking the plan, is they were maxing it out, but they were kind of really cutting themselves short a little bit. They weren't able to do some of the extra things. So they said, hey, as a kind of a bonus to ourselves for working those couple extra years, rather than retiring, if we're working, let's just maybe cut those retirement savings in half. So instead of contributing about $60,000, they dropped that down to $30,000. And we can see what that looks like. And we're going to show that and basically two metrics. One is what is the tax savings over their lifetime, and what is the potential increase to the portfolio, all things being equal based on our assumptions. And we're using a pretty conservative growth rate in here. I think we're using in this one maybe, I can't remember if we use 5.75 or 6%, but you know, something you know, kind of on the lower end of what hopefully is going to be a good long-term average. But we always want to be a little bit more conservative with these estimates here. And so they would save $72,000 in taxes and increase their portfolio value over their lifetime by $178,000. So not bad for just doing one little small change up there. And then we started looking at, okay, well, we know we're going to have some low tax years there. What if we just did Roth conversions and we just took advantage of what I think is the low-hanging fruit? And that would be to, let's do a conversion up to that 12% tax bracket. So we can see here in yellow, there's 4 years of Roth conversions here. You're going to do $129,000 the first year, 115. Again, these numbers change a little bit because there's other income sources coming in. There's inflation, all of these things being calculated. So it's a variable type of a thing here. And so they're putting 4 years of Roth conversions in there. We can see that here. And they go up to that 12% tax bracket. And that has a pretty nice effect, a very nice effect. They save $323,000 in taxes and over their lifetime cumulatively, and because of those tax savings, because they have more of their assets working for them over the long run, they increase their portfolio assets by nearly $1 million. $953,108 is the number that's in here. By the way, if you were to earn a better rate of return, that's only going to favor some of those Roth conversions even more. So just something to kind of point out. That's the needle that moves on that a little bit there. And in the software, the way we illustrate it is we keep all of the rates of return the same across all three of those buckets, the non-retirement, the traditional, and the Roth. And that way, if we're showing Roth conversion going from traditional to Roth, we're not displacing that by saying the traditional we thought was going to make 5.5%, but the Roth we think is going to make 8%. Well, of course, it's going to look better in the software because you're moving money from that 5.5% account to an 8% account. So we keep everything the same. But in reality, as we were talking about earlier, with the buckets that you're going to have, those three tax buckets, you're going to probably want to have more of your growthier investments in that Roth bucket. And that should hopefully grow better than the traditional bucket if you have more conservative investments there. And that's going to just amplify this up even more. But we wanted to keep it so that it was just showcasing what is the tax savings and the tax impact for doing those conversions there. So that all looks really good. Then we said, okay, let's see if we went up to the 22% tax bracket. That looks really good. So it goes saves a lot of taxes, $818,000 in taxes. I mean, these are not small amounts. And I got to say, these are pretty typical. If you have those low tax years and you have a lot of money in those traditional, really to fine tune and really figure out what is the best tax optimization strategy can really be worth a lot to you over the long run instead of just winging it. And by the way, because of our cash flow based plan and because it's taking into account the withdrawals and the growth and inflation and all these other things, I mean, generally, you know, we're going to have a better idea of what those future tax rates are going to look like versus even your accountant or your CPA. Unless your CPA is doing this level of modeling, they're not going to know what your IRA or your 401k balance is going to be 10 years from now because they're not accounting for the additions, the withdrawals, the growth, and all of that to be able to really map that out here. And we can very easily do this. So again, a lot of the work up front is really getting that map correctly. And I always say when we talk about a map, there's two things we want to know is, you know, where are we right now on the map and where are we trying to get to? And really, a lot of it is really all the values and things that you have too. What are the things that you want to do? What do you want to do in retirement? The fun stuff, you know, that type of thing. So, so we're going to get all that modeled in here, but that looks really good. So $818,000 of cumulative tax savings, and it increased the portfolio by $680,000. I'm going to show you a couple of other charts here in a second. What that ended up doing, as we'll see in just a second, is it actually kind of drained out the traditional money pretty quickly, and and basically put them into a very low tax bracket later on. They ended up being in almost, paying zero ordinary tax on a lot of those years there. And so a lot of times when we're trying to do the best optimization strategy, we don't really want to get to zero. I know there's some people talking about that, the power of zero. I think that's really, in my opinion, kind of a fantasy. I don't think that you're ever going to get there if you have Social Security and anything else coming in. The idea of paying zero taxes is probably not a realistic goal. And even if you could do it, it would mean that you could pay zero later, but you're paying a whole bunch of tax right now. And I don't know if that makes sense, because I don't think tax rates are going to skyrocket up to the moon here in the short term here. So usually what we want to do is something that's going to be a little bit more leveled out. So we kind of created a custom one where we did a little bit into that 22% tax bracket. So we did the 12 and a little bit extra. And then we continued on just doing some small Roth conversions on a regular basis. And I think that created a little bit of the best of both worlds. Didn't save quite as much in taxes, but it still increased the portfolio value by more than what being more aggressive with that 22% Roth going up to the 22% tax bracket for the Roth conversion did. So I kind of like this. And it really is something that, you're not going to set your Roth strategy in place here in 2025 and say, hey, that's the strategy, and I'm supposed to convert $127,600 in 2031. You want to look at this on a year-to-year basis, really, and see, okay, was the growth better than you expected in some of those accounts? Was it worse than you expected? Whatever that may be, and you want to look at, okay, well, here, 5 years into it, or even 3 years or 10 years into it, what is it looking like in the future? And it's a rolling kind of target, a moving target that's going to change and adjust. And so it might have made sense to do a $127,000 conversion in 2031, but as you get closer to that, maybe you should do more if the accounts have really grown a lot, or maybe you should do a little bit less. So this is just something that, we kind of map this out, and usually our clients are, working with us and coming to us, my screen just went dark, coming to us on a regular basis to kind of reevaluate this and really kind of dial this in. And you can see that there's some pretty substantial tax savings in here. So the last report I want to show you here, and there's dozens of reports in here, but when we look at it, we talked about earlier in the video, those 3 tax buckets. Here we can see that exact roadmap of those 3 buckets, and it's all based off of what's going into them, what's coming out of them, and the required minimum distributions and things like that. So we can see, most people are going to use up those taxable assets or the non-retirement bucket first, and then they're going to go into their tax deferred. This is under the base facts. We can see those numbers get up there pretty high, and there's another report that has the RMDs calculated for us as well, and those RMDs get up there pretty high too. And then when we look at the different scenarios here, we'll look at our custom one that we did, and we can actually let me compare that, and we can put them side by side, and so we can see. There we go. So we can see what ends up happening with this custom one is we end up with most of the money in Roth, which is great, gives us a lot of flexibility, and we still have some money that's in those traditional accounts, because again, it doesn't make sense to go up to one of those really high tax brackets now in the short term only to pay zero later. I'd rather just kind of smooth that out and really kind of stick in that 12%, maybe low 22% tax bracket. And then if you have a lot more money in these retirement accounts and you're up in the $4, $5, $6 million range, then maybe targeting the 24% tax bracket is generally where we're seeing most people kind of target on that. And we can see here too, the interesting thing that happens under our base fact scenario is that these dark blue lines, which are the taxable investments, those non-retirement accounts, those start to build up again. And the reason for that is because of the required minimum distribution. So their RMDs are actually greater than their expenses, so they start building up money there. And then depending on what that's invested in, that could create an ongoing tax issue with paying interest, income tax on that, or dividend income, or capital gains, depending on what you have it invested in, things like that. And then we'll compare that to the more aggressive one, just to give you kind of an idea. And some people may want to do that. We've had clients that say, hey, you know what, I really think tax rates are going up, or maybe there's a health issue with you or your spouse and you think there's longevity concerns that one of the two of you may not be around long term, and you're worried about going from that married filing joint tax table to a single tax table, or there's a big age discrepancy. If you're 15 years different or 10 years different in age, and you're probably more likely to have that scenario where you're going to have the younger spouse more than likely having to file single tax returns in there. So that drains those traditional retirement accounts, which are the light blue there, pretty quickly and ends up with everything in Roth. Some people might really like that, or if you think tax rates are going up to 45 or 50% or something like that, that could make sense. But I like to do something like this generally, which is to kind of smooth that out over time. So anyway, I hope this has been helpful. Creating a tax strategy is really one of the most important pieces to the overall optimization strategy. But again, the work in the early part of it is, really getting organized, getting all of your assets together, understanding what are the resources that you have, and then planning out that long-term cash flow map, and then really using that to kind of dream and design your retirement and put in all of those things that you want to do. We've had clients, they want to budget in an annual vacation where they take their kids and their grandkids all on a vacation every year, or maybe once every couple of years, or you want to maybe say, hey, things are looking pretty good. We want to get a little beach house place someplace, or we're in Michigan, so up north is kind of the thing to do. So people buy a second home up in northern Michigan, and it's kind of a meeting place where all the family can get together and say, hey, what would that look like if we bought a place, and here's the price we're thinking about. Does that work? How does that fit into this whole strategy? And really mapping that out and understanding what that looks like long term. And then you can get into the optimization, which is taxes, what we're talking about here. I just made a video a few days ago where we talked about the Social Security timing strategy and when to collect that. We talked about break even, and our break even is really going to be more inclusive of that long-term cash flow map, because most of the time people calculate break even on Social Security just based off of how many years do I have to get my money back, but they don't think about, well, if I take Social Security at 67 or 70 as opposed to 62 or 65 or 67 even, there's a number of years where I'm not getting any Social Security benefit, and if I need the money, I'm going to have to take bigger retirement withdrawals from my portfolio. And what is that doing? So this is all inclusive of that, and really putting that map together. So you put that map together, and then you start working on these optimization things. And then as things come up, you can come back to this and say, hey, I want to do some home remodeling. Let's put that in. That's going to mean a bigger distribution next year. Maybe it means a smaller Roth conversion, whatever that is. And then having this piece of software and this tool to be able to, on an ongoing basis, really kind of map that out. So again, we do this through some different financial planning programs. The Retirement Time Machine is one of our core programs, and we priced it very reasonably. It gives you access to the client portal of this eMoney financial planning system. We have office hours on a weekly basis that you can hop on for little 15-minute sessions. We do also include included one-on-one meeting with our team to kind of go through, make sure the plan's really dialed in. And then there's opportunities if you want to do that on an annual basis, you can do that. But either way, both of our programs give you lifetime access to the software, so you'll have access to the portal and you can make changes. Some of the advanced planning, that's something we do in our office, and unfortunately eMoney doesn't have access to that for the client portal, but again, you can do that during office hours and things like that. And then the Money Evolution plan is more of our high-level plan. That includes 4 meetings. It's generally for clients that have a larger net worth, a lot more moving pieces, maybe multiple properties. Maybe they're getting some of those executive compensation pieces like restricted stocks or stock options, deferred compensation plans, higher tax bracket, more moving pieces. And so we have 2 programs for that. They're priced definitely different, but the Retirement Time Machine is probably appropriate for most people. So again, you want to check those out, go to moneyevolution.com. That's our website. We also have a great blog over there too. So we're putting, I think, some pretty good content over there. And then if you want to learn specifically about the Retirement Time Machine, that's available available on our website, but you can also just go to retirementtimemachine.com to learn about that. So thanks for watching. I hope you enjoyed the video. If you did, hit that like or subscribe button, and I'll see you back in one of our next videos. Thanks.